Yo, what's up, peeps? It's your boy Fa-Harra. I'm going on my cell phone right now because I'm at this beautiful event, man. I'm sorry. Like, I'm meeting so many people. It's amazing. It's about real estate. Really to get into real estate, deep more into it. And hopefully y'all enjoy this video. Make sure you like, subscribe, hit the bell for all notifications. And hopefully you get something out of what we've learned today. So we got actually 4 speakers, but I know 2 of them really going to be doing all the, well, 5 speakers, but we got 2 of them that's really going to be doing a lot of speaking about real estate. And hopefully y'all enjoy.
So I started in real estate in 2018. At the time I was still a junior at San Diego State. First semester of junior year, I changed my major from pre-med to communication because pre-med was a route that my parents wanted me to go down, not myself. So I was pretty miserable, depressed, sad, unmotivated in school. Still getting good grades, but just wasn't like the right path for me. And I just kind of had like a quarter life crisis, I guess, and I found that like all my best friends in college, like the most successful families that came from, that were my friends that I met in college, every single parent owned rental property, right? So they all either had their own business, they invested heavily in multifamily and industrial. So one day I joined the real estate study on campus at San Diego State, and first event I go to, kind of like this, it was like a speed networking event. It was where 20 students met with 20 professionals, and 6 professionals in. It was like each 2-minute meetings. I didn't even know what an escrow was, title was. I didn't know anything about real estate. But this one guy at South Coast Commercial, Brian Nelson, met him there, and he kind of took a chance on me, and I started as an intern at his company. March of 2018, got my license, August of 2018. And I basically started full-time my senior year, late 2018. I stacked all my classes on Tuesday, Thursday. I worked Monday, Wednesday, Friday, Saturday for like 12, 14 hours a day. I was just calling property owners all day long, getting told no all day. It's a lot of fun. But anyways, like 6 months in, I got my first listing, $800,000 fourplex in City Heights. Top of the world, and then the owner unexpectedly passed away the next day, and the property goes into probate. And then at that time, I almost quit and decided to get a normal W-2, quit real estate. It wasn't for me. But then we got a really good probate attorney, got out of probate in 2 months, closed my first deal 8 months in, and then before I graduated, I closed 5 deals, and that's where I found out that success and failure live right next to each other, because I almost quit, and my life would be totally different today if I didn't stick with real estate. But anyways, talking too much. But 2018 made no money. 2019 sold 12 transactions for about 20 million first year out of college. 2020 is where I really blew up. Sold I think 25 transactions for, I can't remember actually, 50-something million. 2021, sold 80 million, made over 1.6 million in commissions. 2022, made over 2 million in commissions, and our team sold over $100 million. And then 2020, I bought my first property, and I bought and sold over 27 properties since 2020. So
incredible, huh? Hands for that. The important thing is a lot of times at these events, people come to me what's the easiest way to make some money in real estate? I'm like, the sentence started off wrong, because there's no easy way to make money in real estate unless you inherit it. That's not going to happen. So what Jason's story teaches you is that you've got to really put in the work and lay the foundation for that, right? He's made 6 months of calls, but I bet you some of those people within those first 6 months later became customers unbeknownst to him. So you might not have the reputation, the credibility and the professional experience to do it right off the bat, but you have to build it, right? You have to start your house at the bottom and then go up. You don't start at the top, right? And that's kind of the point of that story. David, how about you? You know, if you tell me your story about how you got into multifamily investing and syndications and why you chose to go that route.
So my first rental property I bought in 2010, that was in West Michigan. I'm from Michigan originally, but I was actually living in San Diego at the time, so it was an out-of-state rental for me. I slowly built a single-family home portfolio up, and I think it was, I moved to Phoenix temporarily, so I was there for, I think, 2014 through 17, and I'd known Ben Leibovich, I'm sure some of you have heard of him, and he moved to Phoenix, so we connected and we started talking about doing bigger deals. And in 2018, we launched Whitehaven Capital, which is a syndication company. And from that point, we've purchased 8 properties total. 5 we've gone full cycle on. Our longest length of time was 3 years. Our shortest was 14 months. Currently, we are still holding 3. That's about 540 units, about 250 million under management.
So these aren't small properties; they're multi-hundred unit properties that you buy.
Yeah, the last one was 240 units, $101 million.
So, go ahead.
Average return for investors has been about 42% so
Yeah.
far, so not too bad.
Yeah, which is huge, right? Because a lot of times you're advertising that you're going to get up 12 to 15%, maybe 10 to 15%, but then the reality is it usually pans out better, but the market's also been favorable.
Correct, absolutely.
So there's a little bit of both. And Steve and Mike, if you want to jump in on these things, because I know you've got a bunch of rentals too, and we're learning the hard way what's good and what's bad deal.
Well, I would tell you what not to buy. Because I've dealt with this in Indiana. Yeah, I mean, obviously taking everything that they're going to tell you, but if a deal seems too good to be true in some of these like Midwest markets, lower priced markets, like we picked up an 8-unit for $99,000, you should probably run away and not do that. It's not going to be a good asset. It's not going to, you're going to deal with a tenant class that is just not what you're going to probably want to deal with unless maybe you have that kind of patience. And you're probably not in an area that's going to appreciate like San Diego or like Phoenix, you know, like the two of the bigger areas that Jason and David are in, right? So that's my expertise to you guys.
Yeah, and I think just to touch on that, so that the project that he's talking about in specific was at a time, and a lot of you might be at this stage, right? So like for us, we were at a time where we wanted to just start growing, right? And we needed to make some action happen. So by the time that deal came into our network, right, which was direct to seller, I think this one came from an SMS campaign. And by the time we saw it, you know, a couple red flags that popped up for us, which typically we don't have to get too far in the weeds, but somebody doesn't have their T12s, you know, even on an Excel sheet and it's on yellow paper, watch out.
That's a
right?
trailing 12, the rent statements for the last 12 months.
Yeah, exactly. Rent rolls, the whole 9, which are, hey, tracking, you know, everybody's rents and deposits, etc. We needed it to work. We wanted to grow. So we made a decision, right? And that decision took us down a route which ended up in a loss. But, you know, if you want to talk about half glass full, which everyone in this room, if you're investing, you know damn well you need the lessons. That's exactly what happened with that property. So, you know, can you find something in the Midwest for $99K? Yes, absolutely. Yes, you can.
Should you run away? Yes, you should.
Well, it depends on your due diligence, right? And Mike and I can do due diligence correctly, right? So it depends what you're looking for. But everybody here, what we notice when we throw these events is that the demographic of person that comes is all over the place. Some of you haven't done your first deal yet. Some of you have done your thousandth deal. And you know, typically I think that's why this 8 is a great learning experience. Was because we wanted it to work so bad that we made it work to where it didn't work. So yeah, that's
It's cash flowing in the beginning, and then you know half the people stop paying, and they're just D-class tenants. So yeah, if we can help you, like teach you what not to do, I'd love to help you guys not make the same mistakes. But these guys are going to tell you what to do, and probably give you a lot better expertise than I or Steve will give you.
Now, for learning from other people's losses is huge, and so Jason and David, let's put yourself out there. Tell me about some losses that you've had. Give me a memorable or educational loss.
Oh man, okay. I think the biggest loss I had was the mistake of hiring the wrong contractor. I think I talk about this a lot on my socials, but basically, when I bought like my first 3 or 4 properties, I had like 5 properties total closed like that I bought for the first time within a span of like 3 months, and all of them needed like heavy, really like insane renovations, like total gut, like new foundations, building ADUs, all that stuff. So a client actually referred me this contractor, and one big red flag was he wasn't licensed. Second huge red flag, he wanted to put like the minimum amount on paper of like what he's gonna do actually to the property. So me being young and stupid, I just like, did a handshake deal, basically signed up like $600,000 worth of rehabs, and I was like 200K in the hole, and he basically done like 50K worth of work. He was telling me like how, he was doing all this plumbing work and how he was doing all this foundation work, like look under there, we've done like, 25 grand here, but in reality it was like 2 grand, he put like some 2x4s there, but I didn't know any better. So I really went through the school of the hard knocks. I lost a lot of money hiring the wrong contractor, and I think the biggest takeaway to like take from my downfall was, number one is don't put a contractor on so many projects. Is 2 is don't always listen to referrals. Always like do your own due diligence. I think I was just too like wide-eyed, and I just trusted my client right away. But anyways, like basically the reason why I lost money was after like I kind of called them out after talking to clients and like my mentors about like what was going wrong. I basically found out I was getting screwed, and after I asked him like do more work without giving him more money, he basically like fell off the face of the earth and blocked me on everything. Try to like find his address, couldn't even find that to like even like press charges, but yeah, great experience.
Correct, yeah, so we also own it's about 30,000 square feet now, a storage facility in Ohio. So we purchased that one in 2020, me and just a couple other partners. And we just actually purchased $150,000 worth of portables to kind of add to the facility, put it around the perimeter, help drive the NOI, bump up the value, and hopefully refinance at the end of this year.
So guys, why do you guys like multifamily and storage business more than single family rentals, flips, wholesaling, any of that other business?
I'd say for me, you kind of run a little bit more like a business, right? So the valuations on multifamily and storage facilities comes from the NOI, right? So if you can really drive the NOI, you can really exponentially increase the value on the property. So
You guys understand what NOI is? Net operating income? Jason, what about you?
Yeah, honestly, I don't have anything bad to say about single family except for that it's just harder to scale, right? It's much easier to own 20 units in one location than 20 units in 20 different locations. So I think from a scalability standpoint, it's much easier to actually manage multifamily. Also, your cost goes down significantly because if you own 100 units or even like 10 units in one location, usually the property management fees are much lower than single family. Like single family management fees are anywhere from like 8 to 10%. My management costs are anywhere from like 4 to 5%. So that's a big difference if you have a lot of doors. So I think from a scalability standpoint and from a cost standpoint, multifamily is just a lot easier to do.
So what comes first? What's up, Mike?
I was gonna say, I was listening to Bigger Pockets the other day, and kind of what these guys were saying is, if you listen to Bigger Pockets and like David Green, he was talking about like how, like we've forced like single family rentals into like being rentals, but like multifamily is actually like set up to be a business. So like they were saying, it's a lot easier to scale multifamily than trying to like buy 100 single family rentals, right? So it's like, where do you want to spend your time at? Do you want to spend your time negotiating with 100 sellers, or do you want to spend your time negotiating with one? Pick or choose, right?
Next question. What comes first, the deal or the dollars?
Well, so if you're trying to raise money from somebody for your own personal deals, I think you should probably have some kind of track record, prior to trying to solicit funds from somebody. But along the same lines, I don't think they're mutually exclusive, right? I think if you're at an event like this, you could probably find 20 money partners and you could probably find 20 deal guys. So, if you can nurture those relationships and build a rapport with the correct individuals, I think you can just put it together and move forward.
What do you think, Jason?
I really think the gold mine in real estate is it's all about the deal. If you have the deal, you can find the money. If you have a lot of money but no deals, you don't have a business. So I really think, especially if you're first getting started, I think it's really important to do your first deal, find a really good one, because if you find a good deal, you can make all the mistakes in the world and still come out on top. I made all the mistakes in the world on my first deal, but I bought a duplex in Normal Heights for $630,000. I renovated it for $250,000. I added 2 ADUs for another $250,000, and the property appraised for $2.1 million. So my renovation costs would have been a lot lower if I didn't make all those mistakes. But that being said, I think what he's saying, you got to understand real estate investing extremely well before you solicit money from family and friends, because the only thing that's worse than losing your own money is losing your family's money. So I think you've got to really find a great deal and do your own deal first, with maybe 1 or 2 partners, and get your feet wet.
Brings me to my next question, which is about syndications. Are you guys using them? Do you think it makes sense to have one partner that provides all the money and is passive, or 10 partners that are active that that want to get in your deal? Tell me a little about that.
So our last raise was $45 million, so we definitely had more than 8 people. We probably had about 300 investors or so on that deal. So, and that's anywhere from $100,000 to $5 million, depending on the person. But what was your question?
Yeah, what's a syndication and how do you use it? How does it work?
So syndication basically is a group of investors that want to pool their funds and their knowledge and take down a property that's bigger than they could possibly do on their own, right? So typically that's broken up between what we call general partners that kind of work with brokers. They find the deal, they do all the legal documentation, they get the financing in order, they manage the property, they run through the business plan, right, and then they end up selling the property. And then on the other side, you have your limited partners, which basically just bring the capital. But a syndication is basically a way that you can purchase a property. Basically, you're selling a security, so you do have to go through the SEC and get an exemption, which is called a 506C or 506B. I think there's a couple other ones too you can use, but that's basically what you're doing.
Yep. And Jason, anything to add?
No, yeah, that was a great explanation. I think syndications are a great way to grow, but I think you also got to know what your personality is. Me personally, I like to have as least many partners as possible, because I don't want someone calling me asking me how their investment's doing. So I've raised money on 2 deals, but out of the 25 something deals we've done, it's been me and 1 partner. I think that's something that's really important. I can say to help you guys is finding a really good 1 or 2 partners where your personalities and your skill sets match together well is really important.
What was that last word you said?
Skill sets?
Oh, okay.
Yeah, so for example, obviously I'm the broker, so I was hitting the streets hard trying to find good deals, and then my partner is a hard money lender. He has a big hard money fund, so we got really high leverage on our first 2 or 3 deals, and bought them at really steep discounts, 60% below market value. Flip those and 1031 into bigger buildings. So that's kind of been our strategy from day one. But of course, everyone runs out of money, so if you want to get to a point where you want to scale faster, syndications are great, but it just takes twice as much the work, or 3 times the work. But
guys, do you have any tips for how to underwrite on a napkin on a deal to make sense? Versus the reality is when you do a flip or a house, you can do a spreadsheet that's 1 page and figure it out. But with multifamily, you have to have about 10-page spreadsheets with a humongous amount of numbers on it that you probably paid someone $6,000 just to put together those spreadsheets, right? And then they have to put in all the assumptions and variables. And it's not easy, but it drills down to the details that the investors want. But savvy investors know how to do this pretty quickly to see if it passes the litmus test of, does this pass enough interest where I can put in an LOI, lock it up for 60, 90 days, and then do further due diligence?
I actually, I gotta go the other angle. When I buy a deal, I look at two things. I have a one-page little Excel sheet to like run, you know, what the rents are today, what the rents can be tomorrow, what the expenses are, and I can just like, I mean, I know San Diego like the back of my hand, so like, if I get a call from someone about a deal, I know right away if it's a good deal or not. So I think the most important thing is to know whether a good deal or a bad deal is like, if you're looking to buy in San Diego, let's say you're looking to buy in North Park, you have to know every single property that's selling in North Park. Let's say every property in North Park is selling for $400 a door, you know, $450 a door. If you find a deal that's $300 a door, that's a great deal, right? So like that's like the first litmus test that I go through to like know if it's a good deal. If I know that the property I'm buying is below market value, then I'll like take time to like actually underwrite it and look at the financials. So yeah, I kind of like know if I'm going to buy it within like a phone call.
David, how about you?
I'd say fairly similar. I know what you're referring to with like some of the single family homes. There's like a 1% or 2% rule or whatnot. But to what Jason was saying, if we get a call from a broker in Phoenix and they say, you know, there's this building that's selling for X amount and it's 100 units and it's funny enough, some of the pricing's similar. So 300,000 or 370 a door, right? And we just purchased 2 assets in that area that are probably going to flip for 470 or 480. You know, we know there's probably something there that we can get into and review, but there's a lot of due diligence. I mean, there's a lot more variables when it comes to multifamily, I think, just because you're not working off the values in the neighborhood so much as you're working off of also what are the cap rates going to be in the future potentially, and that's kind of a whole different discussion, but you know, you're kind of trying to look into the future to see where the economy's headed, where the city and the market's headed, where rents are headed, etc. So.
Properties that might not be listed in selling to institutional investors that are okay with thin returns.
Yeah, I think the higher the purchase price, the higher like the dollar amount, the harder it is to like find quote unquote a good deal, right? So I think there's a lot of opportunity in like the mom and pop space, like anywhere from like 2 to 10, 15 units. The way I found most of my deals was honestly just through the broker relationships I made through being in the industry, doing deals with them as an agent, and then also just talking to sellers myself. If I know they want to sell for a certain price and it makes sense, then I'll usually take it down. Or if I can't, I'll just, you know, send someone like Hanish or something, right? So yeah, I mean, I think there's a ton of way to find deals, but like the best way to do it is just like networking with like 2 or 3 brokers in your area that are actively digging up deals, that are actually young, hungry, going on the phones, whereas a lot of the older people that are like kind of checked out aren't really doing that. So I think it's really helpful to like partner with like a young and hungry broker who's like actively, you know, hitting the streets.
Yeah, I think typically when you get into a larger multifamily, the easiest way to find a deal is probably broker relationships. I know a lot of people send out the yellow letters or cold call or whatnot. The easiest is probably to nurture those relationships with brokers. Even then, you're not going to get like the best of the best deals from the broker, right? They're going to hand you off something that might be like the 2nd level or 3rd level, and you're going to have to kind of cut your teeth on that. And if you can take it down and you can close on the deal, the next one's going to be a little bit better, and the next one's going to be a little bit better. And then you kind of get to a point where you're getting handed off-market deals. But even then, you know, anything that we've been handed that's off-market, I think, we were the only buyer. Everything else, there's still going to be 4 or 5 buyers that broker's going to take an LOI from or a PSA from and take it back to the seller, and they're going to review them and kind of come back to us for best and final. So even though it's technically off-market, you're still competing with other people typically.
Commercial mortgages and how they differ from traditional mortgages, and then go from there.
Yeah, so a 1 to 4 unit loan, the biggest difference between that is a 1 to 4 unit loan is a residential loan, 5+ is considered a commercial loan. The biggest difference when those banks qualify you between those 2 differences is for 1 to 4 unit loans, the bank cares a lot about your personal finances. So they care a lot about how much you make, what's your W-2, you know, how's your credit, all that stuff. But when you get into the 5 units and above sector, which is considered a commercial loan, the biggest difference is that the bank, the lender, cares a lot more about what the property brings in income, and they use a metric called the debt coverage ratio, which is basically, in the simplest terms, how much a property has to cash flow in order for the bank to do the loan after all expenses and mortgage payments are paid. And usually it's in between for multifamily at 1.2 to a 1.25 DCR, debt coverage ratio. So that's the biggest thing. So when you're buying 1 to 4 unit property, even if the property doesn't cash flow at all, you can still buy it if your income's great. But for a 5+, unless you're getting bridge debt, which is a short-term loan to make the negative cash flow into a positive cash flow, if you're getting traditional commercial loan, you have to have a certain amount of cash flow on the property after all the expenses are paid. The huge pro of commercial loans is that it's much less of a pain in the ass than a residential loan. If you bought a house here or bought a 1 to 4 unit property, you know how much of a pain in the ass to deal with Fannie and Freddie on those 1 to 4 unit loans. They basically ask for your entire life, right? But for a 5+, like they just ask for like 2 years tax returns, a personal financial statement, and that's really it. They care mostly about the property, like the leases, the T12s, the profit and loss statements, the utility bills, stuff like that. So the ease of commercial loans is why I love it so much more.
SBA definitely makes you jump through hoops. You can't be a felon, so if you're a felon, find a different route. Also, there's, depending on what else you have going on, I think they made one of our partners pay off their PPP loan from COVID right before they would give us another loan. A little bit weird, but so they kind of make you do all kinds of different hoops.
Did you guys mention that commercial loans are assumable?
No, I did not.
That's a huge one.
Yeah, so depending on how it's structured initially and written into the note or the documentation, you can assume a commercial loan.
Right, because that means you can take over someone's mortgage that they have, which is huge, right? And commercial loans are a little bit different too. Usually they're amortized over 25 years and have 10-year due in 10.
Usually it's a 30-year AM, but usually the fixed rate term is anywhere from like 5 to 10 years. The 5, 7, 10-year fixed, and then an ARM is the most common commercial real estate loan. Also, something I didn't mention is that commercial real estate loans have prepayment penalties, whereas a residential loan does not. And basically, a prepay is when if you pay off a loan early, the bank wants that interest that they didn't get, so they'll put like 1 to 5 points, depending on when you pay off the loan, of the loan amount, which is a fee incurred if you sell the property or refinance early. So that's something you need to look for with a commercial loan as well.
Awesome.
I think another aspect of commercial loans, which is really beneficial, I'm not sure if we talked about it, but a lot of times you'll be able to get an interest-only period of anywhere from 1 year to 5 years to 10 years or whatever, and that really helps if you've got a property that you really need to turn around or reposition. It gives you basically some extra cash flow to kind of help get you through maybe some of the troughs, and then give you a little bit more money to put towards renovations as well.
What's up, peeps? Just making it to the house, man. I made a lot of great connections today. Man, I wish I could have recorded the whole thing, but I didn't bring my other camera, so I was holding it with my hand. I was using my phone, but man, it was amazing. Got great information. Met some awesome people, man. I made some great connections tonight. So big shouts out to everybody that came and spoke. It was crazy, man. I met a lot of people. It was just beautiful. And I that's one thing I do like about San Diego. It's like everybody want to help everybody, you know what I'm saying? Not saying that they don't happen in Memphis or whatever, but it's a different scale because it's just different, you know what I'm saying? I love my city. My city gonna be #1 all the time, but it's just a different culture here. And I'm glad to be able to experience this. So man, I'm tired. Y'all probably heard in my voice. I mingled all night, and hopefully I got some information that somebody need, you know what I'm saying, or somebody looking for in the real estate field. They do this every month. I have some information, you know what I'm saying. Hopefully I have the information I really want to show y'all in the description. I got to go and do my research on some of these people in these businesses and stuff. And so y'all can go in the description and be able to click on some links. But but I love y'all. I appreciate y'all, man. Make sure you like, subscribe, hit the bell. For all notifications, man, it's your boy Fa-Harra, the son of Double AG, and it's IVD all day. One.